Hi, today is June 18th, 2024, and the purpose of this video is for me to try and mimic the same presentation that I do when I'm in front of a group of people. So what we're going to cover are the facts and myths about reverse mortgages, and what I mean by beyond it is to be able to cover the different aspects and the flexibility of reverse mortgages to help you make a determination whether it works for you or not. Now, I'm also going to cover in here when a reverse mortgage does not work and when I would recommend somebody not do a reverse mortgage because it is not for everybody. But my hope is to be able to give you the facts so that you can make an informed decision. But first, a little bit of something about myself. I am a loan officer exclusively with Mutual of Omaha Reverse. All I do is reverse mortgages. I don't do the 30 years. I don't do VAs, FHAs, conventional loans. All I do are reverse mortgages. And I've been doing this for a while, and I'm licensed in both Nevada, Texas, Arizona, and California. I have been involved in real estate in various aspects since 1986. The majority of my time has been spent in commercial real estate. So I do have background in real estate and mortgages, as well as I'm currently licensed as a life and health insurance agent in the state of Nevada, and I have in the past been certified to sell Medicare products. That's the AHIP certifications. I have a few websites down there. You can check me out and freeze this page and take a look at it and check it out, but so much for me. First, the main question, what's a reverse mortgage? There are a lot of people have an opinion on this, but that term reverse mortgage is not exclusive to what we're talking about here today, which is exclusively the home equity conversion mortgage, or HECM, which is an FHA insured product that enables people over 62 to be able to tap into the equity of their homes and not have to give up title or make any monthly mortgage payments whatsoever. That's the simple response to it, but it's important to note here that term reverse mortgage applies and is being used by other people to sell other products that are not the HECM FHA reverse mortgage, which is what we're talking about here today. A little history about the HECM loan. They were originally created by Ronald Reagan back in 1987. HUD started insuring these shortly afterwards, and by HUD I mean FHA. So this is a government insured loan, and they've expanded and changed quite a bit over the time. Good analogy that I heard somebody use a while ago is, imagine you had a cell phone back in 1987 versus the smartphone that you have today. That's a good analogy as to how much change there has been in the HECM loan as time goes by. And one of the most recent changes has been, to be able to use a reverse mortgage to buy a piece of property. And we're going to go into more of that and details of it a little bit later. But there's different ways you can set these up. They can be fixed rate. They can be adjustables on monthly, they can be annually, or we can do monthly draws for life, monthly draws for a specific period of time. We can set these up. They're far more flexible now than what they were in the past. It's important to know that HECMs are negatively amortized, meaning that the loan balance increases as time goes by. A good analogy to use on this is if you had a credit card and you have a balance on it, and you did not make a payment, you know that next month you're going to have accrued interest. Your balance is going to be higher. It's the same principle here with the HECM loan, except the only difference is you're not required to make any payments on it until the loan matures, which is the date of maturity would be the day you die, move out, or sell the house. But there's no prepayment penalty. You can pay these back at any time. But it's important to know that the loan payments are not required. I like this slide right here because it really covers the benefits, and it's hard to really put this into a short period of time. But these are government loans. These are government insured non-recourse loans. And the funds that you receive from a HECM loan are not taxable. It's considered borrowed money. And you can use the funds however you choose. There's no limitations on it. And Let me go into that a little bit deeper. Let's say right now you're healthy, you're looking to borrow something, everything's great. But in the future, we're not going to be as healthy in the future as we are today. But at that time, when you want to borrow some money, you're never going to be asked about any of your health questions. You're never going to be asked about any credit questions. You're only going to be asked where you want the money to go. Do you want it to be wired to the old account that we already have on file, or do you want it to go someplace else? There's no credit checks. There's no health questions when you go to draw on your line of credit. And again, there's no prepayment penalties if you decide to pay this back. And the line of credit is always going to grow over time. So you heard me earlier use the analogy about the credit card where you have a fixed line of credit, but the HECM is far superior to any line of credit that you can think of as far as a HELOC or any credit card, because your borrowing power increases over time. And we're kind of going to go over that a little bit more later. And of course, one of the aspects of the reverse mortgage is that it is non-recourse, meaning the loan is against the property itself. There's no recourse against the borrowers themselves. The sole security for the loan is the property. So there's no deficiency judgment going against the borrowers or their heirs. A little kind of a twist on this that my picture is kind of covering up is that if there comes a time in the future where we're in this strange like 2008 situation where our loans may have been higher than the appraised value of the house, your heirs could buy the house for 95% of its appraised value at that time. I think it's a very rare situation. Somebody would want to do that, but that opportunity is there. But the principal thing to remember is that there's no recourse for deficiencies against the borrowers or their heirs. Now, there is two different types of reverse mortgages here that I'm talking about today, and one of them I like and one of them I don't like. I do like the HECM. This is the FHA insured loan that's protected by FHA. The proprietary loan doesn't carry any protections, and however, the HECM loan currently has a limit of $1,149,825, where the proprietary loan has a limit of up to $4 million. We can lock rates at loan application on the HECM, but there's no locks on the proprietary loans. Personally, I don't like the proprietary loans. I look at them more as a hard money situation. I don't want to go into too much in detail about that, but the main brunt of it's to let you know that they're out there. However, there's some drawbacks to them when it comes to the credit line, and they're not government insured. It's a private loan. I don't recommend it. So the main way that most people use a HECM loan is on a refinance. So the first thing that we do is we establish what the principal limit is, and that's another way of saying a loan to value. And the lesser of the appraised value or the maximum of $1,149,825. So if your property is appraised at $700,000, that's the number. How we establish your principal limit or the loan to value is based upon the age of the youngest borrower or youngest spouse. And that's the number that we go for, because remember, there is a survivor's option in there. So if there's a couple spouses there and one of them happens to pass on, the surviving spouse can remain living in the house without having a maturity event on the loan that would cause it to have to be repaid. That surviving spouse can stay living in that house for as long as they want, and as long as they are still in the primary residence, they haven't moved out or haven't sold the house, they can stay living there. The HECM loan is in first lien position, so any loans that are on that property right now would be paid off to be able to put the HECM together. So you wouldn't have any monthly obligations on your existing loan. The purpose of the HECM is to pay off those existing mortgages. Most solar companies will subordinate and then re-record their lien on the property. So by that, it's easily worked around. If there's any recorded judgments against you and they're recorded on the property, we can pay them off with the proceeds from the HECM. Hopefully, if you do have judgments, they are recorded against the property. Unfortunately, sometimes you have judgments that are not recorded against the property, and then they cannot be paid off with the proceeds from the reverse mortgage in escrow. You would have to pay those off prior to the funding of the reverse mortgage, and that puts a stop to some transactions because the judgment is so large and people don't have the money to pay them off. Of course, if they did have the money, they'd probably pay them off. There's a delta between the payoff and the loan amount that we can establish the line of credit. And once we establish that line of credit, it can be withdrawn or held in line of credit, and the line of credit is going to grow at the same rate as the unpaid balance. Now, what do I mean by that? Let's say we create this reverse mortgage. We pay off some first mortgage of, let's say, a balance of $100,000, and you have an 8% interest that's accruing on that $100,000. Well, if you're a $500,000 property, you're going to have some equity in there that we're going to be creating this line of credit. And I'm going to go into that a little bit later and show you the exact numbers with an example. But that line of credit will be growing at the same rate as your unpaid balance. And it's really a cool aspect of it. And I want you to stay tuned here and so that I can explain it a little bit better and show you the numbers. Now, whether somebody is using a HECM to use as a purchase or refinance, their number one question to me right off the bat is, well, how much can I borrow? And unfortunately, it's not a real easy question to answer, specifically because we don't know what type of loan you're looking at. We don't know exactly how old you are. But if we knew the answers to those questions, then we'd be able to answer the question, because what's the value of the property? And of course, it goes upon the appraised value of the property, and it has to be the lesser of the appraised value or the maximum HECM amount of $1,149,825. It also depends upon the age of the youngest spouse. And what they'll do is they'll say, well, this person is X number of years old and they should live a while longer, and we're going to loan them money because we're going to get paid back faster from somebody who's, say, 85 than somebody who's 62. Because remember, you do not have to make any payments on a HECM loan until the day you either die, move out, or sell the house. So the lender looks at it from the point of view is these borrowers are going to stay in this house until the day that they die. When are they going to die? And there are people out there who try and figure this out as to how long life expectancy is for the average person, and then that's what they plug in to determine how long it's going to take for the lender to get paid back on this. Now, of course, these are interest rate sensitive, so the higher the interest rates go, it results in a lower borrowing power, because the interest is going to accrue a lot faster at higher interest rates and eat into the equity of the property at higher interest rates than it is in a lower interest rate environment. So they are able to lend less money in a higher interest rate environment than they are in a lower interest rate environment. Now, there's different ways that you can do this. We have different adjustable rate loans, and we have a fixed option for you to take a look at. And it depends upon you, what you feel comfortable with. But we're going to go into that a little bit later, and I'm going to show you those differences. So here, I finally get to some numbers for you. Now, there's a lot of numbers, and I know the first time I took a look at this was a little bit confusing to me, so I'm going to try and make this easy to understand by going through this right up at the top. And of course, this is a test, and the age of the youngest borrower in this situation is 76 years old. We have an interest rate, expected initial. Now, what's the difference there? Expected is based upon what they think is going to be in the long term. And this expected rate is based upon a 10-year CMT, the constant maturity treasuries, which is a basket of treasuries that are 10 years. Right now, we're in a little bit higher interest rate environment in the short term. And the short-term 1-year CMT is going to be running approximately 8.525 in this situation. We're looking at a maximum claim amount or the home value of about $500,000. Because of this person's age at 76 years old, or the youngest borrower at 76 years old, their borrowing ability is $188,500. In this example, I'm trying to make it simple. They're choosing to take no cash up front in this example. And they have a $100,000 mortgage on here. There's going to be some closing costs associated with this loan, like there isn't any loan, but we're going to finance a majority of these closing costs right here. And in this case, in this example, it's going to be $19,287.95. And I'm going to break that down for you in another slide. But for now, in this example, that's the closing costs in here. Getting back over here, so your beginning mortgage balance is $119,287. So of course, that's to pay off the $100,000 loan and then to finance the closing costs. This expected appreciation is a appreciation of the home value right now. Over any 20, 30 year period of time, real estate has always gone up. Now, personally, I think that the rates have gone up a little bit faster than that in the recent years. I think in the next few years, it may be slower than that. And there's people who will disagree with me, but I expect it to be slowing down. But if we look at any 30-year period of time, it's always gone up in value. So the initial line of credit in this situation is $69,215 or $212. So that's the amount of money that's available to the borrowers right now. They can take that money. A monthly payment, of course, is zero, no servicing fee. Mortgage insurance premium, 0.5%. Now, what that means is 0.5% on an annual basis. That doesn't mean that you have to pay for it, but that's money that goes directly to FHA and the government as far as the insurance and keeping the insurance on the loan itself. In this example, we don't have a life expectancy set aside and we don't have any disbursement. Now that's life expectancy set aside is we put those together when somebody wants to have the taxes and insurance taken care of for them, and then when the lender does pay the taxes and insurance, then the amount of that expenditure just gets put onto the loan balance and added to the loan balance as time goes by. But when you do that, of course, you're taking away from some of your line of credit becomes unavailable because they set that line of credit aside to use for the future payment of those taxes and insurance. Now, when you look at the schedule here, this year, and of course, this is end of year one of the 76-year-olds. So they would be 76, 77 years old as time goes by and it goes up to age 100. But you look over here and loan balance, it says 129, but then you say, well, why did you say 119 up here? Because remember, this is end of year one. The loan balance is going to be 129. So it grew about $10,000, or you can say 9,622. There's the number right there. But look at this, the line of credit. See how it also grew. We started off with only $69,212. Now, if they didn't borrow any money, now their potential that they can borrow is going to be much higher, because remember earlier in the video I said your loan line of credit is going to grow at the same rate as what is interest is accruing in your loan balance. So you can see over time this is going to grow. And my guess, using a rule of 72, probably in about year 9, this is going, or about 9 or 10, this is going to double. So what we started off with 69.2 in year 10 is going to be approximately, what is that? It's either 145 or 157. 157. So you're going to see the money double in that manner of time. Now, it's not really money doubling. It is your ability to borrow doubles. Now, it's important to note that this example we're using here is based upon an adjustable rate loan, but you'll see that this is all fixed right here. And the reason why is, well, we just can't anticipate how rates are going to go up or down. So for the purpose of this demonstration, we just fix it at this rate to give you an example and an overall like what 30,000 foot view of what the loan looks like. Now people say, oh, this eats into your equity, but what they're not taking into account is that you're always seeing an appreciation of your home value, so that your home equity, even though you have a loan balance on here, your equity position is actually increasing. And in this example, well, it looks like my head's about getting in the way, but it looks like in about year 16 here is about the breaking point where your home equity position actually starts becoming lower and it starts declining because the loan balance has become so strong. But that's over time, and you might want to consider, as years go by, if we get into a lower interest rate environment, just going ahead and refinancing this reverse mortgage. I was actually very busy in the last few years before interest rates went up doing that exact same thing, because people were taking advantage of the higher value of their house and creating a new line of credit and paying off the unpaid balance of their old HECM loans. But if you have any questions about this, be sure and ask me in the comments below or send me an email or comment, and I'd be happy to answer them for you. So on this slide, we're using the attempt to show 3 different loan products and how they work. And of course, this one big and bold is the monthly CMT5. That's constant maturity treasury. It's an adjustable rate loan that has, in this example, has a margin of 3.125, which is the same example we had before. Same $500,000 loan value. And if we go down there, you have the principal limit of the same as 188.5, and bring it down to the principal limit of 169.200, meaning the amount of money they're able to borrow. Now, of course, you have to pay off this $100,000 mortgage, which brings down the amount of money they're able to borrow to $69,200. So the funds available at closing are approximately $18,850. Why $18,000 when you're having the ability to borrow $69,000 is because when these loans were first put together, the federal government allowed lenders to give people all of the money up front. But what they found is people became irresponsible with the money, so they changed the rules to make it lenders not allow them to give all the money up front, but to give them some money up front and then drag some of it for 1 year. So in this example, you have the ability to borrow $69,200. They can get funds available at closing of $18,850, but they have to wait 1 year before they can access this other $50,362 for the total of $69,212. Now, the difference and percentage-wise between the funds available at closing and the available funds after the first year varies depending upon the age of the borrowers. And I don't know how to put a pencil to that or explain it. It's just the way it spits out on the software. One of the differences between this loan program and the one next to it, you'll see that this property charge set aside is here. And in this example, it says not required on the first one. And the second one, it says fully funded. So what's the difference? What it says on the fully funded means that we're going to set aside some of this line of credit so that the lender will then pay the taxes and insurance on behalf of the borrower when the taxes and insurance becomes due, and then at that point in time put that amount of money that was expended onto the unpaid balance. So of course they're not going, the available principal limit is now lower. So in the first example where the borrower is paying for the taxes and insurance on their own, the available principal limit is $69,200. And now, since the lender is going to be paying for it, they're not able to make as much money available. And so in this situation, it'd be $39,600. with the same amount of money available at closing, but you'll see down here the difference is additional line of credit available after first year goes from 50,000 down to 20,000 for a total line of credit difference there of approximately $30,000. Now that's the amount of money that they anticipate given the lifetime of the borrower that they're going to spend in taxes and insurance and the accrued interest on paying those taxes and insurance for the lifetime of the youngest borrower. Now, a different interesting thing to note here, both this first one and the second one are both adjustable rate loans. This third one is a fixed rate loan, and this is available to people, and it's at a higher rate, of course. But the difference here is notice here that your available money or available principal limit, the amount of money that's available to you, goes down. It's not as much money because the lender is incurring more risk at this point. There's no more interest rate fluctuations that they are going to be responsible for, really. So they're taking a gamble that in this situation, this example, the fixed rate of 8.49 is going to be sufficient to them, and they're going to be a good rate of return. But they're going to charge you a higher interest rate to just because it's a risk management sort of thing, really. And the funds available at closing, you'll see, goes down. But the most important thing, and unfortunately my little picture's there and in the way, but the line of credit that we talked about over here, it goes away. So they get a little bit money less at close of escrow, and all of that line of credit goes away when somebody chooses this fixed rate. And the reason, again, is because the lender is just doing some risk management. They're not willing to loan as much money out to people who are choosing this fixed rate because it's just a little bit more risk on the lender's part. So we talked about the refinance, but let's spend a moment and talk about how you can use a HECM to acquire a piece of property. And this is commonly called an H4P or lifestyle home loan. And how this works is very similar, but a little bit backwards. So we're going to use these same numbers, same interest rates, and we're looking at a home value of $500,000, and the principal limit or ability to borrow is about $188.5. You have the same closing costs approximately. They're a little bit higher on a purchase or H4P because escrow costs and title costs are a little bit higher. So you have this remaining principal limit, or your ability to borrow now is down to $168.5. Same purchase price, and we're not going to be doing any life expectancy set-asides in this example. Of course, this next one over there, it is. But to keep in line here, you have the total mandatory obligations of $188. So what you have to have come out of pocket to meet the difference between the $188 and the $500,000 sales price is $331.5, meaning you put down $331,500 for a $500,000 house, and you will not have any monthly mortgage obligations other than the taxes and insurance and normal monthly maintenance and HOA fees for the rest of your lives. So you just paid cash for not really paid cash, but you just made a mortgage payment of $331,500 on a house. So you are able to keep more of your money set aside rather than sinking it into a house. Now you can have that. If you did have that $500,000 total, you now have that, about $170,000 you can invest or spend or do whatever you want to do with it. Now, using the same example, we could do a life expectancy set aside, but of course it just lowers your borrowing power from $188.5 to approximately $162. So you're out of pocket to buy that $500,000 house, increases it from $331.5 to approximately $361.1. So of course you do have the option of getting a fixed rate, and in this situation, that fixed rate would be more out of pocket because, again, the lender is taking more risk, so they're going to charge a higher interest rate. That out of pocket would be slightly higher. It goes from the $331.5 up to $345.5. But again, you'd have the fix. You'd have a little bit of satisfaction knowing what you're going to owe in the years in the future, because it would be a fixed rather than adjustable. Well, one thing we haven't talked about is always assume that these adjustable rates go up. If they can go down too. And if they go down, they go down. So there's some people that are arguing that interest rates are going to go down. Personally, I don't think that's going to happen, but that's my personal opinion. But they might feel more safe in going the fixed route. But once you go the fixed, you can't flip it back over to these other options here. So we've covered the most common uses, and of course this is used to eliminate your monthly mortgage obligations so that you have more cash flow in your pocket, and hopefully you have enough line of credit there and equity in the home so that we can create a line of credit for you for future needs. And on that note, provide a line of credit for future needs. That's a lot of people will create these lines of credit and the reverse mortgage to as a emergency funds for long-term care. If you're smarter than me, maybe you purchased some long-term care earlier on in life, but here I am, 66 years old. I didn't purchase any long-term care. I wasn't that smart when I was younger. And unfortunately, 70% of you out there didn't purchase it either. And so we have to have some sort of emergency. And if you have a house, and that's great, and you have a lot of equity in it, that's great. But if you run into a situation where you have to be going into some sort of assisted living facility for a short period of time, you're going to be away from time, you need that cash. The only way to do it is to sell the house, and then you might have some cash, but then where are you going to live? With this reverse mortgage, you can tap into that line of credit to pay for any future emergency that might come up in your life. And that's what really is a life-changing thing. There are some consumer safeguards that are in place, and they have been increasing as time goes by. We've covered some of these in the past. Of course, these HECMs are non-recourse, meaning the loan, sole security for the property, sole security for the loan is the property itself. And there's no deficiency ever going back to the homeowners themselves in this situation. If you get into another 2008 situation where our home values go way down and you become upside down on the reverse mortgage, you will not be subject to any deficiency on there. And now the homeowner retains title to the home as long as the loan terms are satisfied, meaning you have to keep the taxes and insurance paid. Now, people will always say, well, that's a negative. Well, even if you have a house and you do not have a mortgage on it, you have to pay the taxes. Otherwise, you get foreclosed on. And insurance, well, it'd just be crazy to not have any insurance on a house even when you own it free and clear. But it's always important to have insurance on it. The homeowners themselves, this is not an equity sharing situation. We're going to go into this on the myths in a moment, but the homeowners themselves are always having an equity position. The lender in a reverse mortgage never is taking an equity position in your home. Your equity is your equity. The reverse mortgage is just a loan. It's nothing more than a loan. It's not any equity sharing situation. There's third-party counseling that is mandatory prior to the application, meaning you can talk to me, you can talk to a loan officer, you can get all the information, but because there's been less than honest loan officers, less than honest financial advisors in the past, they want borrowers to be able to have access to a third party, to be able to answer some questions and be able to verify what the loan officer or financial advisor tells them how to use a reverse mortgage, so they can make sure that they're being told the correct information. Now, a loan officer like myself is only allowed to give you approximately 3 pages worth of companies to call and do this counseling with. And by the way, we're not allowed to tell you which counseling company to go through. We have to actually sign something saying that we did not steer you to a certain counseling company, but only to give you the opportunity to choose one from that a list that we give you. The charge for doing something like that is approximately $145 to $180, depending on who you choose to do that with. But that's your business, and that's between you and them. It's not something that you pay us for and we pay them, because that would be a conflict of interest. It's just a thing that the both of you, both borrowers or single borrower, gets on the phone and has a conversation with them to cover these things. And they want to make sure that you understand this is a negatively amortized loan and when the maturity events, pretty much everything that we've covered in this video and we're about to cover. The equity lines can never be reduced, canceled, or frozen. And I think this is an important one. You know, for myself, I had a home HELOC, home equity line of credit with a local bank here in Las Vegas during a 2008 crash. I was current with them and all the payments and everything, but when the crash hit, they took it away from me. And they did that because they were fearful somebody like myself might just borrow a whole bunch of money and then declare bankruptcy. I never did that. My credit was good, but also they wanted to reduce their liability, so they killed the line of credit they had with me. Why I think this is important with the HECM is because this is an equity line that we create with the HECM, can never be canceled, frozen, or reduced. This is a government insured deal. So everybody is insured on this deal. And you do not have to answer any medical questions or credit questions when you want to draw down on that line of credit in the future. And again, this line of credit is going to increase regardless of what the home value is. So if you have a line of credit that's $100,000 and your house goes down to nothing, that line of credit couldn't conceivably be worth more than the home itself. And you could actually pull the money out, more money out than what your house is even worth. It's in theory. So now the fun part, myths and facts. Myth number one, this is the number one myth, is that the lender goes on title and owns the home. It's important to know that HECM loans are just a loan. That's all it is. It's just a loan. When you go to sell the property, you go and you order, the escrow will order a payoff statement from the lender. Once they find out what you borrowed, what the accrued interest is, they pay it off. There's nothing more than, there's no equity sharing situation. That doesn't happen. Now, again, back what I said earlier, this term reverse mortgage is not proprietary to a HECM government loan. So you have these people using this term reverse mortgage for something other than the HECM FHA loan that we're discussing here today. So be very careful when you're talking to other people that you're talking about the same thing, because this is an FHA government loan. And on that note too, it just occurred to me, if you're searching through the internet and you're looking at reverse mortgages and how they work, be sure you're looking at a HECM reverse mortgage in the United States. There are other countries that have reverse mortgages, and of course they're a totally different product. You know, the UK has them, Canada, Australia, and New Zealand, they have reverse mortgages also. But too many times people will look at these videos and they're getting information about a Canadian reverse mortgage. It's important to always make sure where you're getting your information from, and if you're getting the information on the HECM reverse mortgage. The myth number two, the funds from a reverse mortgage are taxed. They're not taxed. This is considered borrowed money, because remember, you're borrowing money and using your equity in your home as collateral, and then you're going to be paying it back at some future time, whether you die, move out, or sell the house. So it is not a taxable event when you're going to be taking some of this money out of your house in the form of advanced line of credit. And myth number three, reverse mortgages are risky and the funds are not guaranteed if something happens to the lender. Well, what happens to the lender is almost irrelevant, because remember, these are government insured loans. And kind of a little known thing here is you're going to be, with the reverse mortgages, you're going to be signing not just one, but two notes and deed of trust. One of them goes to FHA. So in the event that a lender does go bankrupt for whatever reason, the FHA steps right in and they are going to be responsible. Now, again, we're talking about the FHA. HECM is not a proprietary lender product. That other product we talked about earlier, that is a $4 million limit and not the approximately $1.2 million limit on the HECM. That's an entirely different product, and that is not guaranteed. And that's one reason I said earlier I don't like them. I only like these FHA HECM loans. And they've been in place since 1988, and there's lots of safeguards put in place to protect the customers. This is another great myth, is that the borrower can end up owing more than the home is worth. As I said earlier, this is a non-recourse loan, meaning that the borrowers themselves and any of their heirs are not responsible for any amount of money worth higher than what the value of the property is. So if you cannot be held responsible for any deficiency judgment, if you're unlucky enough to have to be selling, like in year 2009, where all of our houses went down the drain as far as value, and you had to sell at that point in time, and there was a shortfall, well, that's not your problem. If you become upside down, that is what the FHA mortgage insurance premium is all about, and that's what covers it. That's government stuff here. This is another big one. This is probably should be one up at the top. And people think that when they get a reverse mortgage, when it comes due, then the bank gets the house. That's just not true. Remember, this is just a loan. And you pay back whatever is you borrowed plus any accrued interest up into the value of the house. Heirs may still receive an inheritance. So if it's a $500,000 house and you owe $350,000 on it, well, you can sell it and take that $150,000, do whatever you want with it. If you were to both die in the house, and your heirs would be able to sell the property, pay off the $350,000 reverse mortgage, and keep $150,000 for themselves. So remember, this is just a loan. This is not taking title to the property. This is just a loan. This one, if you outlive your life expectancy, the lender will kick you out of the home. No, you can stay living in this house for as long as you live. And now, I think there's some little thing on there. If you live to be 146 or 149, you can make a liar out of me and sue me at that time. But you can never really outlive the expectation of the loan. And this does have survivor benefits. So if one spouse happens to outlive the other, which happens all the time, the surviving spouse can stay living in the property without having any maturity event on the loan, having to repay or anything out. They're not going to be forced out. That surviving spouse can do it. And only tell you this is important, because I've done some transactions with some people that were not in such good health, and they were afraid that when they died, that their surviving spouse was not going to be able to keep up with the bills and be forced out of their house. So they actually got the reverse mortgage so that they would not be forced out of their house. So we paid off the existing mortgage, so it increased both of their cash flows, and it certainly increased the cash flow for the surviving spouse once that time in the future did come about. So again, there's no fear about outliving life expectancy. You really can't, unless you live to be 149 years old, and then you can make a liar out of me. This one, you can never get out of reverse mortgage. Well, of course you can. All you have to do is pay it off. You can do it or refinance it, sell the house, whatever. Remember, getting back to the old one, it's just a loan. And there's no prepayment penalties. You can do that. Getting out of it is just a matter of paying it off. Now, you would not want to pay it off completely if you have this great line of credit. You never want to pay it off to zero, because remember, if you pay it off, it goes away. It's not like a credit card where you can bring the credit balance down to zero, because if you did on a reverse mortgage, the reverse mortgage goes away. It doesn't exist anymore, and there goes your line of credit. So it's important to always keep a balance on that. And I'm saying keep it as low as $500. And when you figure what it costs you to keep $500 balance versus whatever your growth rate is at that time, the growth far outweighs any expenses that you would be associated with carrying a small balance. This myth about impacting Social Security, Medicare benefits goes back to the earlier question about taxable benefits. So, no, it will not impact Social Security, will not impact Medicare benefits at all, because remember, this is borrowed money. Now, kind of a small thing here is if somebody is collecting social programs or Medicaid, it would affect it, because now if you're considered on public assistance and we put a bunch of money in your a bank account, that could affect your ability to collect Medicaid or any sort of supplemental welfare type benefits. So that's important to know. But normally, for people who are not on any public assistance, it is not going to affect anything at all. So hopefully you've learned something here today. If I have skipped over something or not made something really clear, give me a call, send me an email, send in the comments below, and I will get back to you, or have somebody get back to you if you're not in one of the states that I'm licensed in, and we can get the ball rolling to see if it's something that works for you or not. And I look forward to your questions and comments. Thanks much for taking the time to listen to this all the way through. Here's my contact information. I look forward to hearing from you. And of course, the next slide is some disclaimers and things that the company makes me put out. But I look forward to hearing from you. Reach out to me if you have any questions.